Hi, I'm Siu-Ling Hui with part 8 of a video series about how your financials can help you manage and drive business success. In this video, we'll look at 4 key profitability concepts: the difference between markup and gross profit, break-even analysis in business expansion, and 2 key profit lines known as EBIT and EBITDA. First, a quick recap. In part 7 of this series, we looked at the financing of capital expenditure. Our capital expenditure consisted of the purchase of a computer and a forklift. We used our own cash for the computer purchase and we borrowed the money to buy the forklift. Taking on debt changes the financial risk profile of our business, but we didn't want to tie up a large amount of our cash in a fixed asset. We're growing the business rapidly, and this means increasing working capital funding. We looked at the effect of using a financing solution that is specifically tailored for funding equipment like our forklift. Now let's set the scene for the next stage of our business growth. We've had a good run so far. We've enjoyed pretty fat profit margins. The widget market is still growing, but it's becoming more competitive. There are many new competitors, as well as increase in suppliers of the widget. The result is downward pressure on prices. Let's say our strategic response is to reduce our selling price to stay competitive. We want to keep our existing customers, and we believe we can grow market share profitably even at the reduced margins. First, let's look at the difference between markup and gross profit. It's very important not to confuse these two concepts, or you could damage your business profits. Markup is about setting prices. The markup is the amount that you add onto the cost of the product. Gross profit is about how much you get to keep out of the sale of the product after allowing for the cost of the product, but before paying for other business expenses. It's the difference between your sale price and your cost. In absolute dollar terms, markup and gross profit look like the same number. For example, if the cost of a product is $10 and the markup is $10, then the sale price is $20. The gross profit is also equal to $10. But in terms of margins, markup and gross profit are very different. The markup margin is the percentage of the cost that you add onto the product to get to the selling price. It's based on the cost of the product. Gross profit margin is the profit you make relative to the sale price. It's based on the selling price of the product. Markup of 100% means you double your cost price to get your selling price. So a $10 markup on a cost of $10 is 100% markup. But that only translates to a gross profit margin of 50%. If your markup is $5 on a $10 cost, that's a 50% markup. Your gross profit of $5 is a gross profit margin of 33.3%. So, whilst markup and gross profit margins are related to each other, it's your gross profit margin that you should focus on. This is the margin that shows you the impact of your pricing strategy on business profits. It's the first line of profitability in your profit and loss. Let's take a look at the profit and loss to understand this issue of markup versus gross profit on the bottom line of our business. We used to buy the widget at $10 a unit and sell it for $20 a unit. That's 100% markup. That gave us a gross profit margin of 50%. Our expenses in August was $1,672. That represents only 8.4% of $20,000 of sales. So we get to keep 41.6% of $20,000 of sales before having to pay tax. Now, let's say that to stay competitive, we have to reduce our markup from 100% to 33%. So our selling price is down from $20 to $13.33. That's a gross profit margin of 25%, half of what we were getting before. In August, we sold 1,000 widgets at $20 each. Let's say the business currently only has the warehousing and people capacity to handle 1,000 widgets a month. So if we stay at this capacity, our total sales will only be $13,330 at the reduced selling price. Expenses at this level of capacity is $1,672. This means our expenses now represent 12.5% of sales. So half of the gross profit of 25% gets eaten up by expenses. That leaves us 12.5% profit before the taxman takes his cut, which is a miserable $1,658. To grow the business, we have to expand warehousing facilities and hire more people. That means increasing the fixed cost base of the business. So, as part of the growth strategy, we hire more people. We take on larger warehouse space. increase the marketing spend. And with higher levels of business activity, other costs like electricity, phone bills, and so on also go up. We also need to buy additional plant and equipment like shelving or racking for the warehouse, furniture, and an additional computer. With bigger premises and more employees, the overheads of the business have now increased to just over $5,000 a month. These types of expenses are fixed costs. They don't change with sales volume to a point. Whether we sell one widget or thousands of widgets, these expenses won't change. If we provided free shipping for those widgets, then we would have shipping costs as a variable cost in our business. If we sell more widgets, our shipping costs go up. If we sell less, shipping costs go down. So we need to generate gross profit of at least $5,195 to get to break even at the EBIT level. That's the profit line known as earnings before interest and tax. Let's leave aside the issue of meeting interest payments for now. Our widget market is growing strongly, but there's huge pressure on pricing. We used to have a markup of 100%. That gave us our GP margin of 50%. If we have to drop our markup to 67%, that reduces our GP margin to 40%. So at this reduced markup, if we only sold 1,000 widgets as we did in August, we would still be able to achieve a small positive EBIT. But we have to drop our markup to 33% to stay competitive. If we only sold 1,000 units in September, we would have a loss of $1,865. If we sold 1,500 units, that's 50% more than we did in August. That's still not quite enough for us to break even with our higher overheads. We need to sell around 1,560 units to just get to break even. That's zero profit before even paying interest. The point here is break-even isn't something that you only think about when you're starting a new business. Whenever you have a significant business expansion that increases your overheads or fixed costs, you have a new minimum level of gross profit that you must achieve in order to get to break-even. That gross profit is a function of both price and volume. Will your marketing strategy deliver the required growth to break-even? How long will it take? How will you fund the business until it reaches break-even? Now, let's take a closer look at the profit line EBIT, a very, very important number. Let's say we've been very successful in driving sales growth in September and October. We've got a lower gross margin, but we're selling enough to generate positive and growing EBIT. EBIT, which is the acronym for earnings before interest and tax, is a very important number in your profit and loss. It shows the ability of the business to meet its interest payments from earnings generated from its operating activities. Interest cover is the ratio of EBIT to interest expense. It shows how many times your EBIT can cover interest payments due. This is one of the key ratios that financiers consider when they are assessing a business for new financing or renewing existing financing facilities. A one-to-one interest cover means that operating activities are only generating just enough profit to cover interest. That is way too skinny. It means that the business cannot absorb any adverse situations. It will only take a slight decrease in sales or margin, or an unexpected expense, or an increase in interest rates to send the business into losses. Our business has very healthy interest cover ratios. Interest cover decreased from a whopping 81 times in August to a still pretty healthy 22.3 times in September. In other words, operating activities generated enough profit to cover 22 times our existing interest expense in September. Note that this is about generating enough accounting profit. It's not about having enough cash to pay interest. Do not confuse accounting profit with cash. There's no hard and fast rule about the right number for interest cover. You really want it to be at least 2-to-1 or higher. However, what it should be for a business depends on a lot of factors. I'll discuss this further in a separate video. There's another profit number that is also important, and that's EBITDA, earnings before interest, tax, depreciation, and amortization. In this layout, I've broken out depreciation and EBITDA as separate line items in the profit and loss. You can just add depreciation back to the EBIT number to get the EBITDA number. Depreciation and amortization are non-cash expenses. So the EBITDA is a sort of a rough proxy of how much cash profit a business generates from its operating activities. It is not cash flow, just a rough proxy for cash profit. Financiers use the debt service ratio as a quick high-level assessment of whether the business produces enough profit to meet interest payments and loan repayments. The ratio shows you how many times your earnings from operating activities cover interest and scheduled principal repayments on your borrowings. As with interest cover ratio, the higher the debt service ratio, the better. Again, I stress this is not cash flow. These ratios are static and based on accounting figures at a point in time. From a business management point of view, the EBIT and EBITDA margins are also very useful for comparing your business performance against competitors or industry averages. One of the issues with external benchmarking is that you have to be very careful that you're actually comparing apples with apples. Businesses within an industry or a market aren't identical. They may handle a different product mix or have different business structures. Using EBIT and EBITDA margins eliminates the impact of investment and financing decisions on profitability. That's why these two margins are better basis for comparison of profitability than margins based on profit before tax or profit after tax. Let's look at a simple illustration. Consider two businesses in the same industry. Both ABC and XYZ own factories and trucks, but ABC has borrowings, whereas XYZ is funded entirely by equity or owner's money. That means profit before tax margin for ABC will be affected by interest expense, but that's not the case for XYZ. So EBIT margin would be a better basis for comparison. There is depreciation expense associated with fixed assets like factories and trucks. But what if ABC holds these assets in a separate entity called ABC2? ABC no longer has depreciation as an expense in its profit numbers, but XYZ does. EBITDA margins provide a better basis for comparison, but it's not perfect. ABC could be paying rental to ABC2 for the factories and may have some sort of service contract for the use of the trucks. These charges may or may not approximate depreciation charges that XYZ uses. So, whilst EBIT and EBITDA margins are better basis for external benchmarking, you still have to use them with care and not to jump to the wrong conclusions about relative performances between two businesses. Let's do a quick recap of what we've covered in this training. Markup and gross profit are related but quite different concepts. Never confuse the two. Markups are about price setting. Gross profit is what counts to your bottom line. Break-even is the point at which a business has sufficient gross profit to cover its overheads or fixed costs. Fixed costs are only fixed to a certain capacity of business activity. When you undertake a major expansion in your business that increases the fixed costs, you should be doing a break-even analysis for this new hurdle. What strategies will you have to get to break-even as soon as possible? You should also think about how you are going to finance the cost of this expansion. We often use the term bottom line to mean the profit before tax or profit after tax line. But there are two other very important profit measures: earnings before interest and tax or EBIT, and earnings before interest, tax, depreciation and amortization or EBITDA. These two profit measures are used to assess a business's ability to pay interest and repay borrowings. EBIT and EBITDA margins are also better basis for benchmarking against competitors and industry averages than margins based on profit before or after tax. In this video, we've focused on the profit and loss aspects of the business. This is only the performance aspect. It's essential to take a three-dimensional view of your business. The next part of this series will deal with the balance sheet, that's the business financial position, and cash flow. It's important to know what funding is needed to support business growth and plan for this in advance. I would really appreciate your feedback on this training. Please put any questions or comments below and I will respond. If you have a specific issue or question about your business finances, you can contact me directly through my contact page. Master your cash flow, know your finances so that you can drive strong, sustainable business growth and thrive. Thank you for watching. If this has been useful, please like and subscribe to my channel.